So can you hear me now? So the number of hours required by professional is 2 multiplied by 525. 525, and that is 1000. 1050 naira. When we deduct it from 1000, we have 120 left. So 120 is the new available hours after we've given professional, and the units produced by professional are going to be 525. So the next in line is application, and application needs application. Application needs total hour of application needs to produce 875 875, and it needed 4 hours per unit. So to do that, in total application we need 875 times 4, that's 3005. That's 3500. But here we are, we only have 120 hours left. So what do we do? Like we've been doing earlier, we'll take all the 120 left. But now the question is, how many units can it produce with 120? Its application needed 4 hours per unit, 4 hours to produce 1 unit. If 120 hours is what is left, then we divide it by what? By the number of hours it's required per unit, and that gives us and that gives us 30, and that gives us 30 units produced by application. Now we can now go on and say, what is the transfer price? What is the transfer price, appropriate transfer price for the product? Don't forget, which of these products do we want to transfer? We want to transfer application. How many units of application do we need? They said the internal demand rather required for transfer is 30 units of application, and it is this same 30 units that A can produce, which simply means that everything that is being produced by application is needed by the leverage division, and the demand, the external demand of application is 875, which means application is even yet to meet its external demand, and there is an internal demand. So for it to be able to transfer to the leverage department, don't forget, we said for one of the characteristics of transfer price is that there must be fairness, and also there must be fairness, and there must be goal congruence. So for you to be able to do this, the transfer price is going to be transfer price going to be at variable cost, and the variable cost of application is 41 naira plus opportunity cost. Now opportunity cost here, which is alternative for gone, it is the amount they will be losing from not selling this price, this 30 available, to the external market. And how much will they be losing? They will be losing the difference between 81 naira, which is the selling price, and which is minus the 41 naira, which is the variable cost. That is the amount they will be losing, the contribution they will forgo. That is the what? That is the opportunity cost, which is what? 40. So when we add this together, we have 81. Don't forget, we already said that in transfer price of a particular item of goods which have a competitive market is usually at the market price, but we have broken it down to say the transfer price is going to be at variable cost. However, what is going to be the opportunity cost of transferring these goods to the internal division rather than sending it to the external market? It is going to be the what? The contribution that will be forgone, which is the selling price minus the variable cost, which is the selling price minus the variable cost. This is one. Two, oh, we are solving question on transfer price, the ensan question. That is what we are solving. That is what we are currently solving. So that transfer price, we're not giving transfer price directly. We're not giving the information to do transfer price directly. We have to first of all check for limiting factor. And having tested for limiting factor, we noticed that we were given directly that labor is a limiting factor. After which we did our contribution. Normally, we get our limiting factor per unit, and also we move on to calculate our contribution per limiting factor. After that, we ranked, then we did the allocation. Then we did the allocation. Then we did the allocation. That is what I've done so far, and that is the information we have here. That is what I've still done so far. So please make sure you are on the same page with me as regards the question. So you have the question on one gadget, then the solution you can be watching from here. That is what I have to do, so that I will have access to the question also. So you can move on. Can move on. So question 2 says that if labor hours in ensan division are limited to 4,670 hours, what is the appropriate transfer price for a unit of application transferred to leverage division. Transfer to leverage division. So here is it. Now, they said the available hours in the organization, or sorry, in ensign division has been increased to 4,000, has been increased to 4,850 or so, has been increased to 4,670. So if we have 4,670, we have to do our allocation again. So we go again and say allocation, the available hours is 4,670. 4,670. And the first period we have to consider is professional. Professional is going to be at 2 times 525. That's 1,050. Units produced is 525. And the next thing is application. We'll get the difference. 4,670. And this is 3,620. This is the available hours. Then application goes again. Application is need 4 hours, 4 hours per unit, and wants to produce 875. Producing that gives a total of 3,005. 3,005. When we deduct this from here, we have 120 left. The 120 left can be taken by foundation. So basically foundation need, how many do foundation need? 1,004. Foundation needs to produce 1,004, and it requires 3 hours per unit. So that's 1,004 times 3, that's 4,002. But then it can't, we won't be able to produce 4,002 because the available hours is 120. So the unit it can produce is just the 120 available divided by the number of hours it requires per unit, which is 3. So it can produce 40 at 3 hours. So the transfer pricing now, the transfer price is going to be at variable cost of application which is 41 naira, and opportunity cost. Now the opportunity cost here is that application can meet its demand to the external market, but for us to be able to produce that special order, we have to deprive foundation the 120 hours it need to produce. We have to deprive foundation its 120 hours it can use to produce for external market. And now the opportunity cost now is going to be the limiting factor per unit, limiting factor per unit. And limiting factor per unit for um contribution per limiting factor for foundation is 9, and application will be needing 4 hours to produce the product that will be sent to the leverage department. So the transfer price is going to be, it is going to be as the 4 hours needed to produce the special order multiplied by the nine naira, which is the opportunity cost, which we are using the limit contribution per limiting factor of foundation, because foundation will not be able to produce anything because we want to meet special order. And this is going to be 36. So 36 plus 41, that's 77. 77 transfer price. Okay, opportunity cost of one is, there is a market which we can sell that 30 to, but there's a market which you can sell that 30 to, but because we want to meet internal demand, we will not be able to send to the external market. And as such, the external division will not be able to get all the external market price. They would have the amount they would have sold it to an external person. So what they will be losing is going to be the difference, which is the opportunity cost now, is the difference between the external market price and the variable cost, because they can get the variable cost from the internal division which they are transferring to. But if they are to sell without with having in mind the fairness we discussed in characteristics of transfer pricing system, they should be able to give a transfer price that that can aid evaluation. So as such, the contribution that will be lost, that will be forgone, will have to be added to it, which in this case is the opportunity cost they will be losing for selling to an insider, to the internal division. So that is that about one. Now two, for two now, we've done our allocation and we can produce professional application. Now foundation does not have all the labour hours to produce 1004 units. However, it can produce 40 units with 120 hours. So what we're now saying now is, because we want to produce a special order, we have to deprive foundation the opportunity to produce even the 40. And depriving it now, we have to divert all labour that are supposed to work on foundation to work on the special order in application department. So as such, there will be an opportunity cost from the perspective of the foundation division foundation. So now what we are going to see as the opportunity cost now is the contribution per limiting factor. Contribution per limiting factor. And contribution per limiting factor for foundation is 9 naira. 9 naira. and it is going to require 4 hours per unit for the special order. So when we multiply the contribution per limiting factor, which is 9, by the number of hours it's required per unit of the special order, we have 36. And don't forget, we are going to use still going to use the variable cost in application department to produce that special order. So the transfer price is going to be the variable cost of the application department and the opportunity cost of the foundation department as well. That's how we got 77. So I hope I've answered that. So we can move on to the next question. And the next question says, if labor hours in ensign division are limited to 8,870 hours. Look at it. The labor hours has been increased to 8,870 hours. What is the appropriate transfer price for a unit of application transfer to leverage division? Now, somebody is saying that is this not related um to the shadow price we did in the afternoon? No, it is not related to shadow price. Why? Because what shadow price is preaching is what is the extra contribution that we'll be getting from adding additional units or additional labor hours of limiting factor. Now, this is not talking about having additional units or additional machine hour of limiting factor. No, it is saying that maybe the company has worked on the limiting factor by saying, okay, we used to have 1,170, now we have 4,670, and in another year we have increased our limiting factor to, we've been able to work on our limiting factor, and our limiting factor has now been increased rather to 8,870. So it is not similar to shadow. This particular one is not in any way related to shadow price. Please don't get it wrong. Shadow price is just talking about how the contribution you will get from adding additional unit of limiting factor. That is what shadow price is talking about. That is what it's talking about. So we move on. We move on. Allocation. So we have changed to available hours. Available hours has been increased to 8,870. So I'll produce prof. We'll still produce prof first. 1,015 naira. The unit produced is 525. When we deduct, so the balance here is going to be 7,820. 7,820. Then we'll produce application. Application is 3,005. So when we deduct it, what will be the balance? Minus 3,005. So that is 4,320. Then we produce foundation. Foundation needs 4,002. Foundation need 1,004 multiplied by 3. That's 4,002. That's 4,002. You deduct 4,350 from 4,002, you have 120. So with this, you have spare capacity to produce the 30 the 30 unit that is demanded by the internal division, the leverage division. So here we say there is capacity. We say there is what? Capacity. Then we go on to calculate the transfer price. The transfer price is going to be the variable cost variable cost, which is going to be at 41 naira. Then opportunity cost. In this case, there is nothing like opportunity cost because there is spare capacity. Opportunity cost is 0. So it is 41. This is the transfer price. So that is all of that question. So we're moving to the next question, which is the past question. I get this. Okay, so here is the question. Here is the question. I hope I can move on. He said X and Y division are two arms of X and Y group of companies. X division manufactures one type of component which it sells to external customers, and also to Y divisions. X sells to external division producing one type of component which is sold to external customers and also to Y divisions. The following information relates to X division. The following information relates to X division. The market price per component is 200 naira. The variable cost per component is 105. We have the fixed cost. The demand for Y from Y is 20,000 per period. Please note this. The demand from Y is 20,000 per period. Capacity is 35,000. That means X has the capacity to produce just 35,000. They cannot produce more than 35,000. And Y is already asking for 20,000, which means we don't even know what the market wants yet. Let's see what the market wants before we can say, do they have the capacity to do they have the capacity to sell to Y division or not, before we can now set the transfer price. Before we can now set the transfer price. Now, Y division assembles another type of product which it sells to external customer. Each unit of that product requires two of the components that are manufactured by X division. Now, they said each unit of the product required two of the components that are manufactured by X division. So what they are saying is, for one unit of product Y, you will be needing 2 units of the product produced in division X. 1 unit of the product assembled in division Y, we need 2 products or 2 units of the product assembled in division X. Please note that. The following information relate to Y division. Selling price per unit is 800. Variable cost per unit, 2 components from X, 2 at transfer price. Other variable cost, which means they will still have to incur some other variable cost even after they've gotten the component from division X. Other variable cost, fixed cost. Demand is 10,000 and capacity is what? 10,000. So now, the major pitfall of this question, according to ICANN, is that you already know that the demand of division Y is 10,000 and you need 2 units of 2 units of the components in division X to produce 1 unit of division Y product. So to get the total product you will be needing from X, it is going to be 2 multiplied by 10,000, which is the 20,000 they already gave you here that is required from division Y. So what many people did this diet was that they had to multiply the 20,000 by 2 again, which is wrong, which is very, very wrong. They already told you that the capacity of Y is 10,000 and Y will be needing 2 units to produce one of its own unit, 2 units of X to produce one of its own unit, which simply translate to what? 10,000 multiplied by 2, which is the 20,000 they have gave you in the information in X above. So you do not need to multiply anything again. That is it. It is very, very simple. Now, they said the group pricing policy, transfer price must be at opportunity cost. Yes, because it must be fair. Where there is opportunity cost, I apply opportunity cost. Where there is no opportunity cost, then you leave it out. It's going to be 0. Another thing is that Y must buy the component from X. Can you imagine? It is a must. It is a must does not mean that you have to sell at price that will not be of benefit to you as a manager of division X. No, you must be able to give a price that is going to aid your own evaluation at the end of the period. Required: calculate the profit for each division if external demand per period for the components that are made by X division is 15,000, 19,000, and 35,000. And 35,000. So let's do like analysis of demand. Analysis of demand. We have capacity. Sorry, let me start with market demand. They say, well, the market demand, you have 19,000, you have 15,000, 19,000, and the whole of the 35,000. And talk about the capacity. Capacity is 35,000, 35,000, 5,000. So when we deduct capacity, when we deduct the difference, here we have 20,000, here we have 35 minus 19, 16,000, and here we have 0. So here we said there is capacity here, there is capacity, there is limited capacity, there is no capacity. There is no capacity at all. Now, they are not telling us that external demand, for you to, and they said internal demand must be met and Y must buy from X regardless. So now you see that Y can X can sell to Y here at variable cost alone because the opportunity cost here is 0, because what the external demand need is 15,000 and there is 20,000 left, and Y is requesting for the same 20,000. That is without problem. Now, for if the market demand for 19,000, the spare capacity available is 16,000. Meanwhile, the internal demand is 20,000, which simply means that because it is compulsory that Y must buy from X, X need to deprive external market 4,000 units of its product, and there's going to be opportunity cost that will be with it. There's going to be opportunity cost attached with it. So for this, for the first one, the transfer price is going to be at variable cost. Under this, it is going to be 20,000. Since there is capacity for the first one, the 20,000 is going to be at variable cost. At variable cost. So for the second one, it simply means that external demand will be 15,000, where internal demand, which is going to be at market price, then internal demand, it has the capacity to give 16,000 out. So 16,000 is going to be at variable cost plus opportunity cost. And opportunity cost. So for this one now, it is going to be the market need the whole of 35,000, and Y want to get 20,000 out of it. That means we have to deprive external market the whole of 20,000 that is needed by Y. So external market can get 15,000, while internal we get 20,000. So this 4,000 will be at variable cost plus opportunity cost. So this is going to be at market price, and this 20,000 internal, which you are going to deprive the external market, is going to be at market price. It's going to be at variable cost rather, plus opportunity cost. I hope the analysis is not confusing. I hope you are getting the analysis. You just need to calm down and analyze it. Just calm down and analyze it. Just calm down. So external here is going to be at 200. Then variable cost is 105. Then for this one, it's going to be at 200. Then 16,000 of it is going to be at 105. Price for variable cost for processing cost is to be 105 plus the difference between 200 minus 105, which is opportunity cost. The external market, this is going to be at 200, and this is going to be at 105 plus 200 minus 105. Which one of it? Where? Let me know so that I can. Okay, I'll take that again. Now, what I'm saying here is I have I have capacity to produce 35,000 units. I have capacity to produce 35,000 units. And the transfer pricing policy of the company says that we must be able, we must sell or we must buy from the X division, which is like it's made compulsory that we buy from the X division. It's like made compulsory that we buy from the X division. So now I have to consider the market because as a manager in the selling division, I have to consider myself and consider my division as well. So now they now said Y division, which is the buying division, needs 20,000, but we don't know the market demand yet. Now the market demand fluctuates. Now a particular period market demand was 15,000. When market demand was 15,000 and we have 35,000 naira, 35,000 units to produce, it simply means that we can meet both the demand of the division Y, which is the buying division, and the external market without stress, without affecting each other. So if we have such situation, that means we have capacity. That means we have capacity. And if we have capacity, the transfer price is at variable cost. And that is the reason I wrote here that firstly, when the external demand was 15,000, external demand 15,000 units, 15,000 units. I still have 20,000 left that I can easily give to internal division. So the transfer price is going to be at variable cost. It's going to be at variable cost. That is the first analysis. The second one is that when external demand was 19,000, what I have capacity to give internal demand at variable cost is 16,000 units. And they said Y division must buy from X division, which simply means that we have to deprive external market 4,000 units and give it to division Y. Giving it to division Y, we are going to incur opportunity cost. And when we incur opportunity cost, we have to consider it because they said opportunity cost must be considered. So the transfer price of the 4,000 which we are going to deprive the market, because we will be able to give the market 15,000. Logically or normally we can give internal division 16,000 at variable cost, but they need 20,000. That remaining 4,000, where are we getting it? We are going to get it from what we should have sold to the market. We now bring it to the buying division and give it to them. So now what is now the transfer price of the 20,000 that will be given to sell it to the buying division? The 16,000 we have the capacity to produce without stress, we will give it to them at variable cost. While the 4,000 we have to deprive the external market is going to be at variable cost plus opportunity cost. Now the variable cost is 105 and the opportunity cost we are going to incur is the contribution forgone, which is the difference between selling price minus the variable cost, which in reality will still give us our market price. Now thirdly, the market demand for the whole of our capacity, and they said Y must buy from us, which simply means that we can only give market 15,000, then the remaining 20,000 we will give it to division Y. And giving it to division Y, that means we have to consider our variable cost and our opportunity cost. And our opportunity cost still remains the same thing. It is still going to be selling price minus the variable cost, which is still going to realistically give us our selling price. I hope you understand. Please kindly indicate if you understand or not. Please let me know. I hope I can continue. So I can continue. Okay. So they said we should get the profit of division. the profit statement of division X. So I have sales revenue, I have internal, at external demand of 15,000, 19,000, and 35,000. So internal demand is going to be, we are going to sell 20,000 because there is spare capacity. It's going to be at variable cost multiplied by 105. So 20,000, which is going to be 2.1. 2.1, then we have external demand. External demand is going to be at 15,000 multiplied by 200 naira, which is the market price. That's 3 million. That's 3 million. 3 million. So we can get, so let's go to when the demand is when the demand is, external demand is 19,000, we are going to sell internal, there's going to be capacity for 16,000, and as that 16,000 will be sold at variable cost because there's capacity at variable cost, while the remaining 4,000, which we are going to deprive the market, is going to be sold at 200 naira. At 200 naira. That is the variable cost plus opportunity cost. That is the analysis we have done. We have done above. That's the analysis we have done above. So here we have 16,000 multiplied by 105. This is 1,680,000. Please, if you don't understand, kindly indicate. If you don't understand, please indicate. This is going to be 800,000. Then you can get the total. You can get the total. Then external demand is going to be 15,000 because they needed 19,000, but we can't give them 19,000 because we have to meet the demand of Y. Y needs to buy from us. It's going to be at 200. So we deprive external demand, external market 4,000, which we've sold to internal demand at the same price we would have sold it to the external market. So this is going to be 3 million. 3 million. So here we go again. B wants to buy. When the external demand is 35,000, we sell to internal demand, internal, at We sell 20,000 which we are supposed to sell to internal demand at variable cost plus opportunity cost, which is in this case 200. We have done the analysis over there. We've done it up. So you can check, and it's going to be 4 million. That's going to be 4 million. By the external demand, external is going to be 15,000 multiplied by 200. 15,000 was not what they ordered for, but that is what they will get because we have to meet internal demand and we factor the cost in. It's still going to be 3 million. So we can go on to calculate the total. This is going to be this plus this. And for here we have so we have gotten the total revenue. So we can now look at the cost. The variable cost is 105. Variable cost, which is going to be 105. Don't forget variable cost moves to the level of activity, and they were able to produce 35,000. They produced 35,000. 105 times 35,000. That's 3 million. 3,675,000. Same thing applies here. I can just come here and copy it. So I have contribution. Please try and be analytical as possible. Let your work be very, very neat, and you can easily attract mark with that. Can easily attract mark with that. I'm trying to get the contribution. So you can now get the fixed cost. Don't forget, fixed cost is a cost that does not change regardless of the level of activity, and the fixed cost here is 1,375,000. 1,375,000. 1,375,000. Our lesson fees costs. So this is the profit. So this is the profit for division X. Which one should I explain again? Which of the external demand should I explain again? Okay, okay. You've gotten it. So we can move on. No problem. So I move to division R. Division I move to division Y rather. I have 15,000 when it was 19,000, and when national demand was also 35,000. So I have the sales. The sales should not stress us that much here. You say 800, 800, 800 naira per unit, and they sold 10,000. I can even bring this one together. I don't need to. Check your WhatsApp. Then 35,000. So this is going to be 8 million. Everything is going to be 8 million. 8 million. So transfer price. So the transfer price you have gotten that serves as, I say, as revenue in division Y, in division X is going to be the transfer price as, is going to see it as cost for division, for the buying division. What is revenue for the selling division will be cost for the what? For the buying division. So we have 1.2 million. We have 2,480,000, and we have 4 million. Negative. Then they said we have other components. We have other component as well. Other component, other variable cost is sold at 250. Other variable cost is sold at 250 naira, and we have to buy 10,000. So that is 2.5 million. All through. Do we have any other cost? Do we have any other cost? No other cost. So we can get the profit. We can get the contribution rather. So fixed cost is 900,000. 900,000, and it does not change regardless of the level of activity. It does not change. So we can get the profit, is 2.5. Then we have 600,000. So this is the profit. We are done with requirement A. We are done with requirement A. I check profit for the second one. You have 2430. Let me see. Is it for X or R? Is it for X or Y? Please check your calculation well. Or others should check. Please check. X, please check. Please check. Please check. Check that you did not make mistake. Can you do that? So the next requirement says that calculate the financial impact on the group if Y division ignored the transfer pricing policy and purchase the 20,000 component that needs from an external supplier for 170 naira each. Your answer must consider the impact of each three levels of demand: 15,000, 19,000, and 3,000, 35,000 components from external customer for the component manufactured by X. So what they want us to do here is they want us to completely ignore the transfer price and see how it's going to affect the company, is going to affect division Y if it goes all out to buy from external supplier who is ready to sell at 170 naira each. Who is ready to sell at 170 naira each? Who is ready to sell at 170 naira each? So what you just do, you don't need to go through the stress of calculating everything again. No, just look at the impact. Now we go again and say impact of buying from external. So we have when we have 15,000, when the external market demand was 15,000, 19,000, 19,000 and 35,000. So you look at it, what is the transfer price at each of these units? The transfer price was 2.1 million. The transfer price here was 2,480,000, and the transfer price here was 4 million. And if you are going to buy outside external supplier, the external supplier is going to be 170 multiplied by the 20,000 we are buying from external supplier. So from the comment and the comment of the examiner and the pathfinder, people were able to get the quantity here, but the answer in the previous solution, which was about 13 marks, was not really encouraging, because many people felt like they had to increase the quantity required by the buying division, from the selling division. They have to multiply it by 2 again after they've done it already in the question. So many people had to go through the stress again, and it dealt with a whole lot of things in their solution. Even when they know the principle, it was just a little details, small details, that affected their solution. So this is going to be 170 naira multiplied by 20,000. This is 3.4 million. So you look at the impact. So we are going to look, it is the impact we are going to look at. So now looking at it here, looking at the impact here now, the impact simply means that if we are buying outside, we are going to incur 1.3 more costs from when we are buying from external demand at 15,000. If the 15,000 that was demanded by external user is given to them, and we will get 20,000. That means there's a reduction in profit by 1.3 million. There's going to be a reduction in profit by 1.3 million because the cost of buying externally, the cost of buying externally is more and high than the cost of buying from our fellow division inside the same organization. That means if we had gone outside at this demand, if we had gone outside, we would have incurred 1.3 million extra. And also, if the external demand is 19,000, we would have incurred an extra 920,000. Would have incurred an extra 920,000. However, if at this 350, 35,000 units, where the transfer price was 200 for everything, we would have saved 600,000. So that is the impact. So the impact here, we have the impact on profit is going to reduce our profit by 1.3 million, reduce profit by 920,000, and going to increase profit by so that is it. Okay, you see your mistake. Okay, so that is it. Do you have any question? Any question? So this is all on this particular question. This is all on this particular question. This is all on this particular question. So please, if you have any question, I'm going to be taking question. Okay, so in the absence of no question, in the absence of no question, I this is going to be the end of our class. It's going to be the end of our class, and I really want to just encourage every one of us that the exam is about 2 weeks. Please and please, the topics we have done are not the topics that we are sure that they will be the only topics that will come out, that will see in exam. No, please try as much as possible to lay your hands on other topics as well. Try and lay your hand on other topics. And like I've said, we are accounting media is here to help you towards your exam. You can bring your um, solution, and we are going to help you attend to it in no time. Even if we are busy, you can just drop it, and where you are finding it difficult to solve, please, it is advisable that this is just a bit out of what you need to pass your ICANN exam. This is just a bit out of it. You really need to sit down on your own, teach yourself. You will make mistake, but at the same time, you are working towards almost perfect, being perfect. You are working towards almost being perfect. So please lay your hands on question. The one I sent, past question, when you past question now, and I so much believe that with practice it is not going to be a whole lot of problem for us, for every one of us. So please do not forget to subscribe to the accounting media. This we have taken our time to help in one way or the other since Friday, even though we had some things beyond our control, even though there were so many things beyond our control that we are not so happy about, which we hope to improve on. We can always improve on so many things. So please and please kindly bear with us, and we hope you subscribe with the accounting media. So on this note, we say thank you to everyone that have attended this class, and we can only wish you success and luck. May God crown your efforts with success. May God crown your effort with success. Thank you, and don't forget to subscribe. Good night, and have a lovely week ahead.